Welcome to Investero. Over the last few years, cryptocurrencies have gone from being a niche interest to a global financial force. Millions of investors worldwide have jumped into Bitcoin, Ethereum, and countless altcoins, hoping to catch the next big wave of wealth. But here's the truth. Many don't realize every trade you make. Every coin you swap, and every dollar you move in or out of crypto is being tracked. And if you're in Australia, the Australian Taxation Office, better known as the ATO, knows a lot more about your crypto activity than you might think. This isn't just a warning, it's a reality. The ATO has built systems that leave almost no room for hiding. If you don't prepare yourself before 2026, you could face serious consequences. The first thing you need to understand is that the ATO has direct access to data from crypto exchanges, both inside and outside of Australia. When you buy or sell through exchanges, they share transaction details with tax authorities. This includes the amounts, the wallet addresses, the fiat conversions, and in many cases, your identity. It doesn't matter whether you're trading on a popular platform like Binance, Coinbase, or even smaller local exchanges, the data flow is there. What surprises many investors is that the ATO has been gathering this information for years through its data matching programs. They don't need you to tell them how much you've made or lost. In fact, in many cases, they already know. Some people think moving their funds to decentralized exchanges or private wallets gives them anonymity. While it's true that DeFi platforms DNT collect the same kind of personal data as centralized exchanges, blockchain technology itself leaves a permanent record. Every transaction is traceable. It may take time, but with advanced analytics tools, authorities can connect wallets and identities. This means even if you think your activity is hidden, the reality is different. The ATO and other global regulators are investing heavily in blockchain analytics companies that specialize in connecting the dots. Once your wallet has touched a regulated exchange, the trail becomes clear. So what's the big deal? The problem comes down to tax reporting. Too many investors assume crypto is still in a gray area, or that it's treated differently than stocks and real estate. But in Australia, crypto is considered property. That means every sale, every trade, and even some swaps trigger a capital gains event. If you're trading frequently, those small gains and losses add up quickly. And when the ATO sees a mismatch between what you report and the data they already have, that's when audits, penalties, and fines come into play. In some cases, willful non-reporting can even lead to prosecution. The real danger here is complacency. Many investors think they're too small to be noticed. Maybe they only made a few hundred or a few $1,000s, so they assume it won't matter. But the ATO doesn't think that way. With automation and digital records, they don't have to pick and choose who to audit. They can scan thousands of taxpayers at once and flag mismatches instantly. And once your account is flagged, you'll have to prove every detail of your trading history. For many people who haven't kept proper records, that can turn into a nightmare. The good news is, there's still time to get ahead of this. Before 2026, you can take steps to protect yourself, not by hiding, but by being proactive. The first step is record keeping. Don't rely on exchanges to do it for you. Many platforms don't keep historical data for long, and if they shut down, you lose access. Use crypto tax software or manual spreadsheets to track every transaction: purchases, sales, swaps, staking rewards, and even airdrops. Having accurate records is your best defense if the ATO ever questions your return. The second step is understanding the tax rules and applying them correctly. For example, if you hold an asset for more than 12 months, you may qualify for a capital gains discount. If you're staking or earning interest, those rewards are considered income at the time you receive them. These details matter because they can significantly affect how much tax you owe. Too many people ignore the rules only to be hit later with back taxes and penalties. Small investment and professional advice now can save you a fortune later. Another step is voluntary disclosure. If you realize you've made mistakes in past years, the ATO gives more lenient treatment to those who come forward first. Waiting until they contact you makes the penalties harsher. By addressing issues early, you show good faith, and that can make all the difference. Remember, the ATO isn't trying to scare people out of crypto. They simply want fair reporting, just as they do with stocks or real estate. But here's where the bigger picture comes in. The ATO isn't acting alone. Around the world, tax authorities are coordinating under global frameworks like the Common Reporting Standard and the Crypto Asset Reporting Framework, which are set to expand further by 2026. That means no matter where you trade, whether in Australia, Europe, the US, or offshore, your data is increasingly being shared across borders. The idea that you can just move your money overseas to avoid scrutiny is quickly becoming outdated. And by 2026, crypto tax transparency will be at a level we've never seen before. Instead of treating this as a threat, treat it as an opportunity to get ahead. Crypto isn't going away. In fact, many believe digital assets will become even more integrated into the global financial system. Governments know this, which is why they're creating clearer regulations and tightening enforcement. By staying compliant, you keep your options open. You can continue to trade, invest, and grow your portfolio without the constant fear of being caught off guard. Think about it this way. If you truly believe in the future of crypto and you reholding for the long term, why put your gains at risk over something as simple as taxes? Many investors will make life-changing money in the next few years, especially if adoption grows and markets rally again. But those gains will mean nothing if they're lost to fines, audits, or legal battles. The smart move is to treat taxes as part of your strategy, just like choosing the right coins or timing the market. The bottom line is simple. The ATO already knows more than most investors think. By 2026, that knowledge will only grow as international cooperation strengthens. You can't outsmart the system by hiding. What you can do is prepare, document, and comply in a way that protects your wealth and your future. Don't wait until it's too late. The decisions you make now will determine whether you face problems in the future or enjoy the rewards of your investments without stress. So as you plan your next crypto move, don't just think about the coins you're buying. Think about the systems you're putting in place to protect yourself. Because the truth is, the difference between crypto investors who thrive and those who get burned isn't just about picking the right tokens, it's about being smart, disciplined. Subscribe to invest.